Hello and welcome to Ask for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. Violence escalating between Iran and the U.S. with a retaliation attack against U.S. forces in Qatar. Yet Wall Street not spiraling here. Stocks actually saw session highs today despite that geopolitical instability. On Wall Street, all major indices ended the day higher while oil prices slipped. And while we continue to explore the implications of rising tensions, we continue looking at our interconnected economy with China and the impact of tariffs. We're taking a look at the China exposure on some of the world's largest companies. And rising tensions in the Middle East haven't shaken the stock market yet, and typically if they do, the losses aren't usually long-lasting. We're taking an in-depth look at possible outcomes of that timeline. Well, while rising tensions in the Middle East are in focus, the challenges between the U.S. and China, we know, do hang overhead. The high-stakes developments between the two nations putting companies with exposure to China in the hot seat. Strategy Risks founder and CEO Isaac Stonefish joins us now with more. Isaac, it's always great to see you, especially on set.
Good to be here. Thanks for having me.
So you are the perfect guy to talk to today because I'm curious, as somebody who knows China, studies China, writes about China, when Xi and the CCP are watching what's going on in the Middle East, what are they thinking, do you believe? How are they assessing this situation?
It's a great question. I think they are trying to balance the risk of all of the different relationships they have globally and trying to figure out how they continue to play Saudi Arabia and Iran and the United States and Israel off each other. And how do they continue to do so in a way that benefits Beijing more than the countries that they have relationships with?
And we know Xi has designs on Taiwan. So this weekend, he's watching President Trump strike these Iranian nuclear facilities. He's watching Trump drop these 30,000-pound bombs. Does that, do we think, affect those designs?
They absolutely do, and the trillion-dollar question is in which direction do they impact them? Is it that he thinks, oh, the U.S. is now overextended, another Middle Eastern war, this is a great time for me to seize Taiwan? Or does he think, I thought President Trump was dovish. He's not. He's willing to use military force, even though it could start a broader war, World War III. Therefore, I should be less likely to seize Taiwan. And it's so crucial to try to figure out and try to parse where Chairman Xi will come down on that.
What do you think China's ultimate role in this conflict is, given that, of course, the Iranian oil is flowing to Beijing?
To Iran, China is far and away its most important partner. I would say bar none. To China, it's not all that important. So the oil is certainly material for Iran. They export roughly 77% of their oil to China, but it's almost a drop in the bucket for China. And the global cost of, say, an embargo of the Strait of Hormuz, I don't think hurts them worse than it hurts other countries and entities that they're competing with.
I want to switch gears here. You have a new report out, which I want to talk to you about. Will you break down, Isaac, the top 10 most China-exposed American companies? Before we get to the names, walk me through the methodology. How do you decide this?
We think China exposure is the most material risk factor that investors, regulators, and the companies themselves don't like to talk about. And so part of our methodology is what you'd expect. It's business fundamentals. How much money are they making in China? It's supply chain exposure. But it's also issues like partnerships and politics. When you're doing business in China, your relationship with the ruling Chinese Communist Party is an excellent proxy and a really meaningful exposure signal itself. And so we pay a lot of attention to that. We paid a lot of attention to how the companies are working in, say, Xinjiang or Tibet, two regions with pretty widespread abuses against local ethnicities there. And we also talk about opacity. We feel like oftentimes when people are measuring certain things, they don't factor in the difficulty of measuring. So the more the companies are transparent about their China exposure, the lower their scores are.
So that's the methodology. You plug in your variables, what comes out? Who makes the list?
Iconic American brands. And so top of the list, General Motors. Ford was number one last year. They've dropped several places, but they're still in the top 10. Coke and Pepsi are both in the list. Tesla, which I think is an iconic American brand now, is in the top 10. Walt Disney. And it's a surprising list.
One company that didn't make the list, which I was interested in, Apple. Why not Apple? I mean, a lot of people think the iPhone maker would make your list.
So they were in the top 10 last year. Apple has spent decades being very heavily exposed to China and to the Chinese Communist Party. And over the last several years, they've very, very quietly been decoupling from China. And so there's been focus on the supply chain elements of their decoupling, moving to India, moving to Vietnam, potential investments in the United States. But they've also been quietly unwinding relationships with the Chinese Communist Party. And as you know, Apple's a very zipped up company. But when you're doing business in China, companies and entities are paralyzed with fear at offending Beijing. And so you have Apple doing something which would get it a lot of credit in the States, would get it plaudits for actually reducing its China exposure, but Apple doesn't want to talk about it.
Final question for you, Isaac. I'm just curious, how do you think American companies long-term should think about the opportunity in China and how big that opportunity is? Because it feels like one of the very few things that Republicans and Democrats can actually agree on at this point is that China is a problem and China is an adversary.
I think they need to start thinking about the middle term as opposed to the long term. Long term, great, very important for planning. Middle term, how are they going to deal with a possible US-China war over Taiwan? And so think about what's going to happen over the next 5 years. How do you get through that? And then you can look at projections into 2030s.
Isaac, it's always great to see you, especially today. Thank you, sir.
Thank you.
Time now for what to watch Tuesday, June 24th. We're going to start off on the Fed. We're going to be getting some commentary throughout the day from Fed Chair Jerome Powell and Cleveland Fed President Beth Hammack. Powell testifying in front of Congress in the morning. That will be for the semi-annual monetary policy report before the House Financial Services Committee. Moving over to earnings, few big names reporting Tuesday. Carnival Cruise, FedEx, and BlackBerry. FedEx announcing results for the fourth quarter after the markets close. Analysts expecting new tariff rules to hurt earnings this quarter. The de minimis exemption ending, which allowed low-cost Chinese goods to skip tariffs, but FedEx may get a boost from companies rushing to ship goods ahead of tariffs. And checking in on the consumer, we're going to be getting monthly consumer confidence data for June in the morning. Economists forecasting that number to tick up slightly to 99.8. That would be signaling consumers are feeling slightly more optimistic about the economy than they were a month ago. Stick around, much more Ask for a Trend. That's still to come. U.S. stocks closing near session highs as investors weigh on Iran's retaliation to U.S. strikes. Yahoo Finance's Jared Blikre joins us now with the trading day takeaways. Jared.
Thank you, Josh. We got to talk about geopolitical shock, and it can happen in both directions. So it looks like this attack on the U.S., which is not quite an attack on the U.S., however you want to spin it, we saw risk markets respond today. Just want to show you real quickly the sector action first. Very impressive screen here. Only thing in the red is energy, and we're going to get to crude oil in a second, but that is a massive turnaround from what we were seeing at the open. It wasn't dire, but things were heading in the wrong direction. Now I want to show you crude oil futures. Here's the two-day chart. I just showed this at the close. We were up 4% when we opened last night, and that was on fear, that was on risk, and then we closed down about 8-9%. We haven't seen a move like that since May of 2020 in the wake of crude oil, WTI crude oil going negative. And I just want to show you, we have crude oil volatility, by the way, on Yahoo Finance. The ticker is what is that? Carat OVX. There you go. Let me just show you the year-to-date real quick, because you can see we had a massive risk premium built in, and that is just getting shredded right now. So things are moving in the right direction.
Didn't we also get, my friend, some Fed speak today?
Ooh, we did. Fed cut in July. First, we heard some rumblings about it from Waller last week, and it was Bowman today, Vice Chair Bowman. And it's interesting because I just posted a piece and did a video segment on how we could actually get a series of rate cuts this year, maybe starting in July. This is all based on not my work, but the work of Alfonso Picatiello over at the Macro Compass. And he outlines the fact that today we are in a better condition with respect to inflation and with respect to employment than we were in 2019, even though the Fed cut 3 times in 2019. So why wouldn't they cut right now? And it looks like July is on the table. And I also got to talk to Luke Lloyd today at the fledgling Luke Lloyd Financial Company. This is for Stocks in Translation. The episode airs tomorrow, but we talked about this very subject, Fed rate cuts. Take a listen.
When you actually have tariffs, geopolitical events that cause uncertainty, it decreases spending in the economy, and that is all disinflationary and deflationary. So you ask the question, when should the Federal Reserve cut? My opinion, 6 months ago, but they are still late to the game. Just like they were late to the game on the way up, they're going to be late to the game on the way down.
The Fed does tend to be late to the game, but I think the Fed is realizing that the things are kind of falling in place here. I wouldn't be surprised to see the July cut. I didn't expect it to happen a week ago, or it was a week ago, but we'll have to see what happens, what comes of it.
How is all this playing out finally in crypto land?
Great question, because we had a Bitcoin nail biter and it dipped below 100,000. I'm going to pull up my crypto heat map so we can do some charting here. Let's actually just do it right here. And there we go. There's Bitcoin, 104,000. Now this was, let me just show you the 3-day price action. This hit what, 98, 99,000 and change. And that got a massive risk reversal on all the news today. But what I was pointing out at the open, and this is before we got that major reversal news, all this is, and this is a year-to-date chart, so this is the last month of price action in Bitcoin, that is just a bull flag. And we've seen this before. Here's a 3-year chart. All the way back in 2024, we saw a lot of consolidation. Bitcoin went sideways to down for almost the entire year, a good part of the year, frustrating traders. So we've only seen about a month of that or so, and we could see a little more. But in the meantime, I don't see that as cause for concern.
What's on the Jared Blikre radar for tomorrow?
I am watching more Bitcoin as a risk proxy and also crude oil, just the incredible moves we're seeing there.
Yeah, wild moves. Thank you, Jared. Appreciate it. Stick around. Much more Ask for a Trend still to come. Iran retaliating against the U.S. today, launching missiles at a U.S. base in Qatar. As conflict in the Middle East ratchets up, we're taking a look at how geopolitical tensions historically impact markets in our chart of the day. Yahoo Finance's Josh Schafer joins me now with a closer look. Josh.
Markets typically do react to what is happening geopolitically, but not necessarily for a long time. So what we're looking at today in our chart of the day, this comes from Morgan Stanley's Mike Wilson, is S&P 500 performance after geopolitical tensions have risen. This is looking at more than 20 instances back to 1950. And what you're looking at here is the average performance for the benchmark index a month later, 3 months later, 12 months later. Of course, the key takeaway from the three of these, markets are almost often always higher as we move forward with this conflict. So a couple reasons why that might be. Of course, markets are forward looking, right? And so something that we're seeing happening right now is maybe markets move to an extreme case, stocks go lower, oil spikes, and then the concern sort of hits a peak, and then stocks are able to rebound off of that. Now, this is, of course, not always the case. Some of the instances Wilson looked at that would not look as positive for this, you could go back to the 1970s oil spike, or you could look at 2007 and the U.S.'s escalations in the Middle East then. Of course, both of those instances, there was also multiple things happening in the economy at the time. That could have been a potential headwind. But again, on average, stocks usually do bounce back after we see these bouts with geopolitical tensions.
And because, Josh, I know, while I have you, that you've been reporting and writing a lot about oil, the black gold, I do want to ask you about this move today. I'm looking at oil, Josh, down nearly 9%. We're back to 67.3. What do you make of that move?
Yeah, Josh, I mean, it was a massive fall that we did see in oil today, right? And so the interesting part of that decline to me was, well, it came after Iran actually fought back at the U.S. today. They retaliated, and then that sort of traders took that to maybe mean that there was Iran is done for now, then there's going to be negotiations. Again, as I had previously mentioned, sort of peak uncertainty, right, had maybe hit, and then there's sort of your de-escalating from that point. But I will say, Josh, we've talked a lot about that $120 barrel level on WTI, right? We've been keeping our eyes on that. That's where strategists would get really worried. When you move down 9%, you're even further from that. You're at $67 a barrel. It is a long way from what economists and many strategists would consider a concern in terms of inflation and in terms of the overall economic story.
All right, Josh. Thank you. Appreciate it. Markets facing a volatile year as uncertainty from trade policies and geopolitical risk keeps Wall Street on its toes. For more on ways to mitigate investing risks, let's get to Yahoo Finance's senior columnist, Kerry Hannon, joins us now with a closer look. Kerry.
Well, great to be here. The message is really what we hear all the time when we have this sort of edginess about what should we be doing with these geopolitical events or other things that are happening within the economy, and it's stay the course. You need to stay invested. You can make strategic adjustments, but the real focus needs to be on what are your goals? Where are you going? No rash moves. It's impossible, you know this very well, to time the market to sell and get back in at the right time. So particularly for people who are saving for retirement, it's very important to, think of the long term. Realize that where you're investing in your retirement plans through your employer, you are buying when the markets have tanked. You are buying when the markets are doing great. So it all seems to even out over time. So it's a matter of, taking a breath and giving yourself a bit of a time out to not react emotionally when you hear these things. The other piece that actually helps a lot, so it's having the long-term thing, understanding that you can rebalance regularly. It's important to take a look at, are your asset allocations where you want them to be for your time horizon, for the amount of risk you're willing to take. There are variables there. And the truth is, back to those employer-provided retirement plans, many, many people are in target date funds now, target retirement date. These funds automatically are rebalancing for you all the time between equities and fixed income and bonds. So I think that you need to realize that there is some calming forces out there. The final thing is, cash can be cool, okay? Having a cash comfort zone. I personally find it very reassuring when things get a little crazy to know that, in fact, I do have some cash set aside that I can weather, whether there's, the market goes down, whether, layoffs are in the future, whatever it might be, a recession. If you have some cash holdings, it will really bring you some peace of mind.
Thank you, Kerry. Always good to see you.
Thank you.
That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.